We often talk about several trillions of dollars needed for energy transition in Indonesia, but also across ASEAN. But the reality is that if you go to investors or policymakers in Europe or US, they will tell you there's a lot happening here in Europe or US. There's so many opportunities, and therefore, we haven't been able to focus on opportunities in Asia. So we're all competing on industrial side, but also competing in terms of money. And therefore, we need to tell exciting story so that investors in Europe or US will be excited with the opportunity here in Indonesia. So we need to encourage investors in Europe and US and say, whoa, we need to have more exposure in Asia because it's impactful, but also exciting, and expected return is much higher than Europe or US, right? So that's where the conundrum is, right? If you want to invite more money from Europe or US, you need to show that there's interesting story, but also returns.
Hello everyone, welcome to CSIS Spotlight Inside with me, R.D. Wardana, as your host. Thank you for joining us today, wherever you are listening on. We have fascinating conversation lined up for you on topic that's very critical for our future: banking's role in financing climate action in developing countries. To help us explore this topic, we are honored to have Mr. Tomohiro Ishikawa, the Chief Regulatory Engagement Officer at MUFG Bank, with over 25 years of experience in investment banking and sustainable finance. Mr. Ishikawa has played a significant role in shaping MUFG's efforts to support climate change, including the commitment to net zero emissions by 2050. Please welcome Mr. Ishikawa. Thank you for joining us today.
Thank you very much.
Well, as we know that it's a pressing issue in the world about global finance in climate change, because as we know that banks and financiers are taking a big role in this landscape of climate change. So today we'll be diving into the role of banks in financing climate actions, especially in developing economies like Indonesia and the South Asian region. So let's start with a broad question, just to set the context of this conversation. How do you define the transition finance in general?
So first of all, thank you very much for having me. It's a pleasure to be here. So the way I think about transition finance, there are a couple of ways you can think about it. There's a lot of discussion about whether we should define what transition finance means, but it will probably mean transition in Indonesia versus transition, for example, in Japan versus US or Europe, completely different. So I don't think it makes sense to try to come to one concrete definition of what constitutes transition or transition finance. I would rather think broadly and say our support towards our corporate client, their transition strategies or transition implementation of their transition plan, we can finance, we can support their transition strategy implementation through financing, right? So I would think that broadly as a transition finance rather than try to come to a global, concrete, defined terminology of transition, because it would be completely different. For example, just like acquisition finance, I was an investment banker before becoming this reg affairs or net zero guy. Acquisition finance, there is no globally aligned term of acquisition finance, but you see acquisition finance happening everywhere, right? Do you really have to agree to one common definition? I'm not sure. As long as we agree that we are all here to finance our corporate clients' transition or transition strategy, then that should be regarded as transition finance, and we should all encourage more transition finance, regardless of whether we're talking about developed country or developing countries.
All right. So based on what you mentioned before, as long as we finance the transition efforts or the climate action plan, what do you think the role of multinational banks like what you're in right now, MUFG, in driving transition toward net zero emissions?
So one thing about transition finance. So there is of course, debate about greenwashing or transition washing.
Right. That's an interesting point.
Exactly. So if you're selling, for example, green fund or transition fund, then obviously you need to have a concrete definition of what constitutes green or what constitutes transition, because you're selling some product to investors, especially if it's retail investors. But when we talk about broadly about transition finance, I don't think we should try to come to a global common definition of what constitutes transition, because at the end of the day, as I said earlier, transition in Asia versus Europe, it would be completely different. In terms of our role in driving net zero, our role, I would frame this conversation by saying we are enabler or we are supporter of transition. We're not driver, right? We're not the one who's going to go out and capture CO2. That's not our role, right? We finance our corporate clients who has concrete, credible transition plan. The good news about a bank like us is that we cover all regions, from Europe, US, of course, Asia, which is a home market for us. But we also cover all sectors, right? Whether it's high emitting sectors or green sectors, we cover all sectors, including retail, SMEs, but also global leading companies too. So that's why, as a result of all these sectoral but also regional coverages, I think we have a very good views about what's happening in which area, where do we see best practice or good practices, what are the lessons learned from other regions, and what can we do for the purpose of mobilizing more capital to this region.
I see. So we know that you're also a member of the steering group of the Net Zero Banking Alliance, the NZBA, established, and if I'm not mistaken, in Glasgow in 2021, right, in COP. And could you share to us some insights on the alliance and its significance since its establishment in 2021?
So Net Zero Banking Alliance was formed, I think it was 6 or 7 months before the Glasgow COP. So April 2021, it was established. Initially, we started with, I think, 30 plus members. Now we have more than 140 plus members. So we, all major GSIBs from Europe, US, and also Asia, including Japan, are member of Net Zero Banking Alliance. The value that Net Zero Banking Alliance delivers is that we're not just saying we're committed to net zero, period, but the Net Zero Banking Alliance were formed to encourage members to set targets where relevant to reduce their emissions. And Net Zero Banking Alliance lists out 9 sectors, high emitting sectors, to set the target and reduce the finance emission, not only 2050, but also 2030 interim targets, aligned to 1.5 degree scenarios. Of course, depending on your lending portfolio or where you operate, you may have more exposure to a certain sector or less exposure, right? So it's not like there's one size fits all, but Net Zero Banking Alliance is telling the members, these are the 9 sectors, and these are the sectors where if you set targets and encourage your client to reduce emission, that's where you could make the most impact. Now, 3 years since or 3.5 years since we established the Net Zero Banking Alliance, where I would say in Net Zero Banking Alliance 2.0. Okay. Why? Because the original timeline was to set interim target by 36 months after you joining the alliance. So now most of us have done the target setting. Now it's about implementation, right? Target setting, to some extent, of course, it's not easy, but it's more about number crunching, right? You have existing portfolio, you have this 1.5 degree scenario. Where do you need to hit by 2030, and therefore you get to 2050 net zero? To some extent, it's a modeling exercise. It's a number crunching exercise. But when it comes to actual emission reduction, you cannot do this alone, right? it's more about your client, because unless your client reduces their emission, there's no way we can reduce our emission unless you start divesting. But if you start divesting, you're not sustainable. Two more things. One is that we have also included capital market activities as part of target setting. So it's not just the lending, but lending and capital markets will be under the scope. We also have a more emerging market participation from to Net Zero Banking Alliance. Again, it was initially more from Europe and then US, but I think more than 1/3 of the members of Net Zero Banking Alliance is actually from this region, APAC. So Net Zero Banking Alliance is not just a kind of initiative encouraging members to reduce their emissions, but more supporting, facilitating to broaden the scope in terms of products, but also in terms of geographies.
So you believe in this alliance as one of the driver or one of the tools to get more banking sectors or more clients of the bank get into the net zero emission targets?
Yes, Net Zero Banking Alliance has been the, I would say, engine of banks to commit to net zero. But again, committing to net zero and delivering net zero, completely different, right? So now it's at the stage where we actually have to do the heavy lifting, working with the clients, and that means working with the government and all the stakeholders, right? To not, I wouldn't say, again, not drive, but support, enable real economy transition. So that's where we are.
All right. Okay, let's shift our discussion to blended finance. It's sort of a buzzword around the world because, yes, as we know that in NYC Climate Week or even in the NGA, everyone talks about blended finance, right? And your white paper, MUFG white paper as well, highlights its importance. But as we know that according to the OECD data just released on May 2024, in developing countries, only 30 cents of private investment comes in for every dollar of public or catalytic funds. But as we know that blended finance aims to crowd in the climate investment to the climate change sectors, right? Why do you think that this happens? I mean, what are the challenges of developing countries face right now in scaling up their blended finance or climate finance in general?
So we published our transition white paper a couple weeks ago. I think it was September 2024. We stressed that some projects, especially in this region, are not bankable because of the risk involved with that project or the companies. And when projects are not necessarily bankable, but still generating some cash flows, then by bringing in some catalytic capital, whether it's public institutions or philanthropies, then those projects may become bankable. And we, as a private institution, and of course, we don't manage our money, right? We manage depositors' money, right? We cannot just irresponsibly deploy our depositor money and say, oh, we tried, but we lost money. No, it doesn't work that way. We need to prudently manage our depositors' money. So we should only be financing bankable projects, and blended finance can increase the bankability as a result of public sector taking some risks. However, what is challenging in blended finance is that normally equity investors takes higher risk but takes higher return. Right. In the context of blended finance, it's the other way around. Right? Those public sectors taking higher risk need to accept lower return, so that the total blended cost of capital or cost of lending will decrease. Bankability will increase. Right? So that's the tricky part. But whether it's the World Bank or ADB, I'm sure there's a lot of good work that's happening at these MDBs, the multilateral development institution, but they were not developed to do blended finance, right? For the last 30, 50 years, they've been doing more financing to develop infrastructures in developing countries, and they've been doing on their own. Now there's a lot of discussion about blending capital with private sectors. So there's, I guess, that shift of mentality that's needed, at the at MDBs, whether it's the World Bank or ADB or other institutions, so that they always think, how can we maximize the impact but reduce your financing, rather than say, okay, we'll finance everything and we don't need private sector.
And let's move on, specifically talking about Indonesia case study. What sectors do you think are the most critical in terms of reducing emission in Indonesia? I mean, as we know, that energy right now is the largest contributors of CO2 emissions in Indonesia. But do you think other sectors, and is there any specific or particular sectors that do you think that Indonesia are, playing a very critical parts in terms of the global climate change or the emission factors?
So clearly, energy or electricity sector is number one priority. This is not just about Indonesia. Actually, Japan is in a similar spot. When we published or developed white paper 1.0, the first analysis we did was look at the breakdown of CO2 emission. And for Japan and many ASEAN economies, it's energy sector. In some countries, I think more than 45% or even 50% CO2 is coming from energy. And that's where you want to prioritize. And unless you are able to decarbonize energy sector, other sectors cannot decarbonize, right? Because all other sectors, whether you're talking about auto, steel, glass, they all need energy. And when energy is brown, their whatever they produce would be also brown, right? So that's why energy transition is number one priority, and that's why we have been involved in Just Energy Transition Partnership (JETP) for both Indonesia and Vietnam from the beginning. Because unless you prioritize energy transition, you cannot accelerate the whole of economy transition. For us, Indonesia, we have a subsidiary called Danamon. So where we see Indonesia as a very strategically important market for us. So we're not just cherry picking lucrative transaction and say, okay, that's great, we contributed to Indonesia's transition. We have skin in the game. We very much think Indonesia's decarbonization or net zero journey is our journey to net zero too. But then you also have to think about how Indonesia or ASEAN as a whole can grow its economy, right? Energy is just the beginning, right? But you want to industrialize. You want to create a resilient economy. Energy is not the end of the story. It's just the beginning of the story. So is this about auto? Is it about IT? Is it data center? So you need to have an industrial policy, right, on top of the energy transition strategy, so that you can develop the economy, resilient economy, rather than just focusing on energy and hopefully some other economy will grow. That you need to have that strategy as well.
Right. Whoa, that's interesting. I mean, people say that energy transition and also industrialization can't really go hand in hand, because sometimes if we want to pursue environmental friendly growth, it doesn't mean that you will grow actually, right? So yeah, it's somewhat like a trade-off, people say it, but many researchers and also professors already say that it can go hand in hand, because while we have the growing industry, green industry, we can also have a growing economy as well in the country. So that's a pretty good statement from you. And probably this is the last question for me. As we look ahead, what opportunities do you see for collaboration between global financial institutions, multinational banks, governments, and the private sector to enhance the financing of climate action, particularly in Indonesia?
We often talk about several trillions of dollars needed for energy transition in Indonesia, but also across ASEAN, right? So we're talking about trillions of dollars of opportunity, right? We should all be excited rather than say, oh, that's too much, right? I don't, but the reality is that if you go to investors or policymakers in Europe or US, they will tell you, they told me there's a lot happening here in Europe or US. There's so many opportunities, and therefore, we haven't been able to focus on opportunities in Asia. True. So we're all competing, right? Competing in the context of industries like auto, like IT. That we're all competing on industrial side, but also competing in terms of money, right? It's not like there's unlimited amount of money. They're only limited, and therefore, whether it's Indonesia, ASEAN, Japan included, we need to tell exciting story, right? Narrative, so that investors in Europe or US will be excited with the opportunity here in Indonesia or throughout the ASEAN. For example, in the EU, I think it was early September, there was a report called Draghi report, which was published, and they're talking about 800 billion euro needed every year. It's a big amount, right?
For the European countries?
Yeah,
or
Europe
okay.
to transition, but also to maintain and regain competitiveness of the EU. 800 billion. Here we're talking about $1 trillion every year. Japan needs $800 billion or so in the next 10 years. So we're talking about billions or trillions of dollars here, there, but they're only money is not unlimited, as I said earlier. So we need to encourage investors in Europe and US and say, whoa, we need to have more exposure in Asia because it's impactful, but also exciting, and expected return is much higher than Europe or US, right? So that's where the conundrum is, right? If you want to invite more money from Europe or US, you need to show that there's interesting story, but also returns. But how do you minimize your funding cost, but making sure that the investors in the US or Europe will be attracted? There's always a trade-off. But unless you invite and also make them excited, the money will not come. Money will not fly to the emerging economies. So that's where we need to be strategic, not just talking about transaction by transaction, how do you minimize the cost of a particular financing opportunity, but rather, I think it's important to think about the huge finance gap you want to fill. What kind of investor do you want to fulfill that gap? And think about the financing strategy rather than just look at one by one. So, for example, there's all talk about disclosure, there's talk about transition plan, there's also the taxonomy. You have all the tools, right? The question is that sufficient to mobilize billions and trillions of dollars to this region? If not, what else do we need? That's something we should start thinking about rather than just focusing on the tools that we have now, and hopefully that will be sufficient to mobilize trillions of dollars.
I see. All right, that's a very insightful conversation. Here come to an end of our conversation today. Thank you so much for joining us, Mr. Ishikawa, for sharing your expertise and also the insights today. It's clear that the role of bank as well as the multi-development banks and other financial institutions are crucial in our transition to a green economy. And to our listeners, thank you for tuning in. And if you enjoyed today's episode, I hope that you subscribe and also leave a review on your favorite platform, the CSIS Spotlight Inside. Stay tuned in our platform as well and channel. And until next time, take care and continue to support climate action in whatever you can. Bye-bye.